But if bond yields are going back up potentially to 5 and have to reset, how does that, won't that hit the, say, small caps more? How are you thinking about that?
Well, I think the important thing is to think about the linkage here, which is that the rise in bond yields that would come as a function of strong growth, and so that is actually a good thing for unloved corners of the equity market and that rotation story. And I think in general, when you look at the overall equity market, you've got that handful of, that small handful of stocks that drove a fair amount of the rally in 23. Those are priced to perfection in the sense of they certainly could continue their strength, but there's a very high expectations going on. If you start to talk about, small cap value, it's priced for misery. And so, getting something moderately better than misery is could easily be a surprise to the upside for a lot of those markets. And so that's really where I think the opportunity here is not necessarily to go with the trend of the previously hot performers, but it's to look in those areas that have been unloved, who are most likely to benefit from the continued strength in economic conditions, and frankly, some of the improvements in their balance sheet and their overall circumstances that they've taken while times have been a little tight here the last couple of years.
And so I think that there's been some perception that small caps, smaller companies, smaller to medium-sized companies are just destroyed in a higher interest rate environment. It depends on how high the rates are and what the underlying economy is. It sounds like you're saying there is a situation where a strong economy with elevated interest rates is something that they can live with if they're doing well enough. It's not that higher rates are always going to wipe out or make the cost of borrowing so punitive that they can't thrive.
That's right. And actually a lot of those a lot of the tension that we've seen over the last 2 years has challenged some of the crappiest ones of those, the ones needing capital on an ongoing basis. And have washed a fair amount of companies out.
Great point.
And so what we're left with, as an example, if you look at Russell 2K, its weighted average borrowing cost is 4.2%. If nominal GDP is growing at 5 or 6, a 4.2% borrowing cost is totally manageable for those companies, right? And a lot of them have found ways to term out the debt that they have. The companies that are still in those sectors have found ways to term out the debt, and so that they're actually benefiting, not nearly as much as sort of the biggest companies from this environment, but they're not nearly a bad a shape as you might think. And this chart shows back to through 23. But if you were to draw it even further back, of course, these companies, took some real pain over the course of the last 2 years. And so I think there's even more catch up that can be done on a longer term basis from these companies that, really up until just a couple of months ago had been treading water for a very long time, for a while.